Europe is debating today potentially directly sanctioning or even stopping buying Russian oil. If that were to occur, I could see two scenarios. One, Russian oil just keeps flowing, inventories build up, prices could go down, or markets get even tighter and prices go higher. What do you think?
Well, it'd push hot prices higher because Europe would have to source barrels somewhere else in the world. So that immediate reaction of having to reshuffle oil around the world would be quite bullish. It won't change anything in terms of the longer term implications. But I think doing that, gas is the more critical one, not so much oil, which Germany is going to most likely block this. The bottom line, Germany Inc. simply doesn't work without that low cost gas coming through the pipeline from Russia. So they're going to push back on this. It would be, short of catastrophic in terms of economic growth to shut those gas pipelines. That's why we take the view it's mutually assured destruction, both on the Russian side as well as on the German side, to stop those gas flows. I like to point out the only time they've ever stopped was 1941.
Yeah, it is amazing. And you've got companies there. Everybody hates the atrocities that's going on in Ukraine. We totally understand that. But it's also gotten really cold this week in Europe. And there's a risk of people that can't afford to heat their homes. So it's really a Hobson's choice. Like, it's an impossible decision, Jeff. Do you think it is possible that Europe would cut it off? I mean, they talk about it, but I don't know where they'd even make up 10, 20% of their power needs from.
France is talking about it. Germany is pushing back. So, we'll see how far these discussions get. But I think it just goes to the point. It puts an undue pressure on people for heating their homes, industry to keep operating because you're unable to replace that gas. Oil can be shuffled around because it's on ships. Gas, on the other hand, is much more difficult to shuffle around because it goes through pipelines or LNG tankers, which need special ports to even load, to actually offload, which makes gas the more difficult one. Oil, it'd be a little difficult if you put a boycott on oil consumption in Europe of Russian oil, but you could deal with it. Gas, on the other hand, simply just cannot be dealt with.
Yeah, and that's the case. So let's talk about this. Tomorrow, Jeff, you've got a number of big oil CEOs going to be dragged up in front of Capitol Hill and yelled at basically by Congress about higher gasoline prices. Whether it's justified or not, I'll leave that up to our audience. Who knows? But I guarantee you I know what they're going to say. They're going to say, listen, we lost a bunch of money for years. Now we're making some money, but there's a structural deficit. How much of what's going on in oil and gas markets right now, Jeff, is caused by years of underinvestment? Some of it, by the way, self-inflicted wounds, but a lot of it based on regulatory and policy issues, which, without trying to get too political, simply make it harder. Like we just talked about ESG with CalSTRS earlier in the program, harder to get any money to build new projects.
Yeah, you're spot on. The term we give it is the revenge of the old economy. This problem dates back to 0809 when we saw capital redirected to the new economy, choking off the investment that needed to be put in place going back for at least a decade to grow the underlying supply base. And not only oil, gas, metals, agriculture, the entire old economy. And let's not forget, banks are old economy as well. And so they don't have the capacity right now to expand the capital required to grow the supply base. Now, let's think about this. A year ago, oil was, call it $50 a barrel. Today, it's $108. That's twice the amount of working capital this industry needs today than it needed a year ago, which makes it really difficult for everything to operate. And as a result, inventories are being drawn down, which puts upward pressure on prices. Liquidation of financial positions like our markets, these, take Brent, WTI. The overall open interest is just collapsing right now because there's not enough capital in the system to support it. Then you take what you're talking about on ESG, you create a really tight supply situation. And I want to point out, demand destruction is not a long-term solution. The only long-term solution here is getting capital into the markets.
Yeah, and Jeff, there was a report out by your own company, albeit on the stock side. I don't know if you saw it, about EV adoption and hybrid adoption by 2040. And my colleague Pippa Stevens wrote a great story about it yesterday. And And it talked about how, 50% of the market in the U.S. is going to be EVs or plug-in hybrids by 2040. I actually thought the story in the report from Goldman was very bullish oil, because if 50% of the market is part of that is plug-in hybrid, which means you're still using fuel. And it also meant that the other 50% of the fleet in the United States is still going to be a traditional internal combustion engine, not to mention India, China, emerging markets. They just want a little bit of what we had 30 years ago. The demand curve for oil, longer term, I know people don't want to hear it, but it seems strong. No?
Absolutely. And here's the problem is policy's asymmetric. It's focusing on management of demand, as you just pointed out with EVs, and it's not even focusing on how do you wind down the supply of these hydrocarbons. And what we're seeing, ESG is just doing a blatant reduction of capital availability, which reduces the supply, yet they have this longer term demand outlook that 2040, as you point out, and it creates these massive imbalances that we're witnessing today right now. And it's going to take years to dig out. And again, I want to emphasize, it's an old economy problem. It's just not an oil and gas problem, which means, you think about how do you solve any type of physical constraints on economic growth? You have to grow the underlying supply base. And I think that's the critical message here. And the only way you're going to get capital into this market is through higher prices. The way I think about it is these markets are screaming, give me capital, give me capital. They're going to keep going higher and higher and higher until finally capital flows.
Yeah, doing the math on the SPR release, Jeff, I read the DOE release. It was confusing, but it looked like 160 million barrels over 180 days. They had 20 million previous, I think. The new one starts May 15th, so just under 1 million barrels a day is how I read it. Tell me what you think. And is that enough to change the dynamics of oil pricing?
First of all, we got to see who takes this oil. Remember the program they announced last November, only about a third of the barrels were taken. And again, the parts of the world that need this oil are not in the United States. They're in places like Europe. So you not only need to release that oil, within the North American market, you got to get it to the places where the shortages are to actually, because think about what the shortage is right now. It's gasoline, refined products. You got to get to the refineries that don't have access to the oil. So there's a lot of question marks, but your math is right, somewhere around 1 million barrels per day. But let's look at what's lost. We lost somewhere around 1.4, 1.5 million barrels per day of Russian oil. Then you had that problem with the Kazakhstan, throw another 1 million barrels per day on top of that. And demand growth, as you come out of lockdowns, and likely you're going to see China come out of its current COVID problem, demand's going to grow higher, supply's not there. You need a lot more than 1 million barrels per day to fill that gap.